US dollar, the world's ultimate reserve currency. 680 billion are in circulation right now, more than half of those outside the United States. Central banks all over the world have reserves full of them. Countless international transactions are conducted in them every day. And if you're processing transactions in US dollars, even if you're not an American bank, and even if the underlying counterparties aren't in the United States, there are some pretty important US laws which may apply to you.
When you work in the financial sector, you're taking on a great deal of responsibility, and one of your responsibilities is to help guard that sector against infiltration by criminals, terrorists, and others who wish to move money around for the wrong reasons.
U.S. authorities' focus on money laundering is really to prevent the U.S. financial institution from being used as a tool to further criminal conduct.
We're going to look at two of the most high-profile cases of non-compliance in recent years. We're going to examine how two major international banks failed to pay sufficient attention to the U.S. laws governing their activities and the massive fines which the U.S. authorities hit them with. Our first case concerns Dutch bank ABN Amro. With 3,000 branches in over 60 countries, ABN Amro was one of the largest banks in Europe prior to its 2007 takeover by the Royal Bank of Scotland. But their New York branch took a massive hit when the U.S. Federal Reserve and the Financial Crimes Enforcement Network found their compliance procedures woefully lacking.
Under the Bank Secrecy Act, banks, as well as other financial institutions, are required to maintain anti-money laundering law compliance programs. Those internal controls include customer identification requirements, assurance that the bank is reviewing transactions and reporting them correctly under U.S. law, and that the bank monitor its transactions and relationships with customers for suspicious activities.
Within ABN's New York branch was the North American Regional Clearing Center, the NARCC. The trouble started when in 1991 the center began providing clearing services to outside institutions. Suddenly, the clearing center had correspondent accounts with banks all over the world.
A correspondent account is an account held by a bank at a bank in another country. In essence, it allows that foreign bank to get access to the host bank's banking system, so it's a way of extending your banking reach throughout the world.
The risks are really what's the nature of the bank, particularly if it's in a jurisdiction which isn't well supervised.
You have to realise that what you're doing is taking on all of the risks that the other bank is taking on.
The United States government identified correspondent accounts as a potential risk for money laundering and flow of criminal proceeds into the United States.
When you take on a correspondent bank as a client, you have to do quite extensive due diligence on them, right from the basics. Are they a bank? Are they regulated? You're going to need to make sure that their anti-money laundering procedures are up to your domestic standard. So do they have the correct due diligence that they're doing on their customers? Do they have a transaction monitoring regime? Do they have a suspicion reporting regime? And crucially, are their staff trained regularly and well to the standard that you would expect of your own staff?
But despite the risks, the center had no formal due diligence procedures until 1999. And even then, staff just weren't gathering enough documentation and information to know their customers fully. Account monitoring, a key requirement under U.S. legislation, was another area where the bank fell down badly.
Over 30,000 transactions were processed daily through the ABN Amro U.S. dollar clearing operations. However, the company really didn't maintain any formal and sufficient process to monitor those transactions. In fact, up until 2002, it had one person designated to review those transactions.
And this single employee had other significant responsibilities and couldn't devote enough time to monitoring. Even after the installation of an automated monitoring system, the lack of complete due diligence records severely limited the bank's monitoring capability. And what alerts the system did throw up could hardly be handled by the 3 busy staff members who were assigned to analyze them. By the middle of 2003, the clearing center had 400 clients holding correspondent accounts. But an internal review showed that they didn't have the necessary information on 50% of those clients. And what's more, the monitoring system didn't include information from suspicious transaction reports or on correspondent accounts that had been rejected or closed. Take this case by way of example. In January 2002, the New York branch of ABN Amro filed a suspicious transaction report involving a bank in a state of the former Soviet Union. 6 months later, they closed all of this bank's correspondent accounts at the clearing center. However, the suspect bank then proceeded to open accounts with a second institution, which, in turn, held correspondent accounts with ABN's clearing center. Over the next year, via this second institution, the center cleared $100 million worth of transactions involving the suspect bank. In October 2000, the US Government Accounting Office had published a report specifically detailing the risk that criminals in Russia could use shell companies as a means of concealing identity. Now, information about shell companies operating within the US was publicly available. But the clearing center didn't incorporate the information into its monitoring system. As a result, in one 12-month period, the bank processed $3.2 billion worth of payments involving U.S. shell companies and Russian institutions. Training in ABN Amro's New York branch was also found to be inadequate.
If staff aren't trained, you don't have an AML program. Who executes it, who actually makes the reports, looks for suspicious circumstances, or has the ability to analyze the product of automatic monitoring systems.
Compliance staff were found to be ignorant of key aspects of the relevant legal and regulatory requirements, including on the detection and reporting of suspicious transactions. The clearing center had been filing only 2 or 3 suspicious transaction reports each year. After an inspection by the authorities, that number swiftly rose.
Even when they started making more reports to the federal authorities or the local banking authorities, the reports were perfunctory and lacked quality.
Some raised supposed suspicions of terrorist financing without any justifiable cause, whilst others even left off the most crucial part, the transaction details, such as the payees and beneficiaries of the funds involved. The U.S. authorities gave their verdict in no uncertain terms. The Financial Crimes Enforcement Network, FinCEN, fined the bank $30 million. The Federal Reserve and the Office of Foreign Asset Control, OFAC, pitching in with some sanctions-busting activities not described here, fined them $40 million. The New York State Banking Department added to that figure with a fine of $20 million. In respect of Chicago-based transactions, the Illinois Department of Financial and Professional Regulation levied a fine of $15 million. To round it off, ABN Amro made a voluntary donation to the Illinois Bank Examiners Education Foundation of $5 million. The Federal Reserve and OFAC fines were allowed to be paid in lieu of the FinCEN fine, but the total amount paid out by ABN Amro was still $80 million. And that doesn't take into account all the extra costs incurred in additional audit and remediation. I guess an awful lot of extra work needs doing to put that back into the bottom line.